All right, welcome back to another episode of the Black Bullion Show. Let's settle this once and for all. How does gold perform during deflation? Well, I'll answer that shortly, but first, if you're new to this channel, please hit that big red rectangular subscribe button right down below. Also, please hit the like button. It helps to get this economic evangelism out there, over there, right out that window to the masses. Okay, how might gold perform during a period of deflation? Well, let's get into it. Now, I'm not going to read all of this. I'm just going to read two key sections that set the scene. First, it is well known that gold tends to perform well during periods of high inflation. It is less well known how gold might perform during a period of deflation. Most analyses have focused on gold's outperformance during periods of high inflation. Less has been written about gold's performance during periods of global deflation, mainly because there are few examples of global deflation in the past century. During the only extended period of global deflation, the Great Depression of the 1930s, the gold price was fixed as most countries were on the gold standard, making it difficult to analyze gold demand during the period. Okay, so what could be assumed about gold during a period of deflation? Well, here's another section: loss of confidence in paper money during periods of deflation. There is a clear logic to why gold demand should rise during periods of global deflation. Most periods of deflation are accompanied by sharp declines in domestic demand and systemic financial sector problems. Governments and central banks are forced to step in aggressively to offset the slowdown in private sector demand and repair the balance sheets of financial institutions. This generally leads to large injections of paper currency into the financial system and sharply higher government debt levels. As the supply of currency rises and concerns about debt levels rise, investors fear paper currency devaluation and look for alternative assets to hold. In addition, concerns about financial institution and even government solvency and counterparty risk raises demand for alternatives to paper currency. In an environment like today's, when all major economies are facing severe recession, potential deflation, systemic financial sector crisis, and the risk of currency devaluation, similar to the situation during the Great Depression, gold stands out as the main alternative to paper currencies. And hey, we're seeing great gold performance right now during what is now officially, by the National Bureau of Economic Research, it is now officially labeled as a recession. And obviously, I think we are in a depression. Okay, so what other info from recent times do we have to point to how gold will perform in a deflation? Well, how about some data from 1971 to 2019? Now, this comes from the World Gold Council. Beating inflation, combating deflation. Gold is long considered a hedge against inflation, and data confirms this. The average annual return of 10% over the past 49 years has outpaced the Consumer Price Index. Gold also protects investors against extreme inflation. In years when inflation was higher than 3%, gold's price increased 15% on average. Over the long term, therefore, gold has not just preserved capital, but helped it grow. Notably, too, research by Oxford Economics shows that gold should do well in periods of deflation. Such periods are categorized by low interest rates, reduced consumption, and investment, and financial stress, all of which tend to foster demand for gold. And that is currently what we are living in right now. So let's see here. Check out this chart. Now, this is gold's performance in nominal and real terms. Nominal returns are in purple, real returns are in pink. And this is year over year data from the LBMA gold price and assisted with the USCP lie between 1971 and 2019. Okay, so this is during periods of low inflation, below 3% or equal to 3%. And this is periods of high inflation, over 3%. So during periods of low inflation, the nominal return was 5.62%. The real return was 3.58% during low inflation. During high inflation, nominal return was 15.05%. Real return was 8.34%. So that is where I will leave it. Let me know what you guys think about this data. To me, it speaks volumes, and it says that if you hold gold now, you will get a return. And it'll be a pretty decent return in real terms and pretty decent in nominal terms as well during periods like today. Whereas there are certain assets you can get into right now where you will actually lose money. So you will actually get a return if you hold gold during periods of low inflation. So let me know what you guys think in the comments section below. Thanks again for watching. Hope you guys feel comforted during this period of contraction. And I hope you guys are, feeling good about your stacks. Please give the video a like. Please subscribe. Thanks again. It's Black Bullion.